In a world where economic uncertainties seem to be the only guarantee, looking back is more than just nostalgia. It's a necessity. Ever wondered why each crisis seems more devastating than the last? Why our economic defenses appear increasingly fragile? Well, you're not alone in this. Today, we will embark on a thrilling journey through financial storms, from the tumultuous crises of 1998 and 2008 to today's uncertain landscape. If you're concerned about the future of your investments, this video is a must-watch. Brace yourself to dive deep into the gears of the economy and discover how you can shield yourself from the next big collapse. In 1998, the financial world was shaken by an economic earthquake that originated in Russia. A nation of its magnitude was never imagined to fail in honoring its debts. But it happened. Russia, in an unforeseen move, defaulted on its external debt, and the ripple effect was instantaneous. The ruble, its national currency, plummeted at a frightening pace. This maelstrom wasn't confined to Russian borders. Markets around the world felt the tremor and went on high alert. And when discussing this period, one of the most intriguing tales is that of the long-term capital management, LTCM. Many believe the collapse of this gigantic hedge fund was solely due to the Russian crisis. However, here's the reality. That's a major myth. While LTCM did suffer immensely from the Russian upheaval, there were other factors at play. And the danger of this misconception is underestimating the true causes and complexity of financial crises. It became so severe that the Federal Reserve, the central bank of the United States, had to step in, taking drastic actions to prevent this individual crisis from morphing into a global financial cataclysm. And this intervention, my friends, stands as testimony to how swiftly economic crises can have worldwide implications.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets.
As 2008 dawned, the economic environment was already showing strains. But it was on September 15th of that year that the real storm hit the global markets. On that day, Lehman Brothers, an institution deeply rooted in American and global financial history, filed for bankruptcy. The unthinkable had occurred. The impact was immediate and overwhelming. The shockwave spread so widely that major names like Morgan Stanley and Goldman Sachs found themselves on the brink, nearly consumed by the chaos. What was happening? It was like dominoes, where the fall of one piece threatened to topple the entire system. The gravity of the situation was so immense that, once again, the Federal Reserve had to act. They weren't merely dealing with a bank's bankruptcy. They faced a crisis threatening the fundamental framework of the global financial system. The Fed, recognizing the urgency and magnitude of the situation, took extraordinary steps to avert a total collapse. And this crisis, like the one before it, teaches us a vital lesson: the interconnectedness of our financial system, and how a fault at a single point can have catastrophic implications for everyone. Therefore, it's crucial to understand, study, and be prepared for such eventualities. We navigate recent financial history, a troubling trend emerges. The magnitude and destructive potential of crises are on the rise. From isolated bankruptcies to economic tsunamis threatening to sweep global markets, the nature of financial crises is becoming more intricate and interconnected. Why is this happening? The reasons are manifold: financial globalization, market interdependency, and increased speculation, to name just a few. But the most pressing question is, how do we protect ourselves? As aware investors and citizens, where do we find refuge in times of instability? This is where tangible assets come into play. These assets, rooted in the physical world, have a track record of resilience during financial downturns. Land, due to its finite nature, real estate, serving a fundamental human need, precious metals like gold and silver, which have stood as stores of value for millennia, art that transcends economic whims, and natural resources that fuel our world's machinery. These assets have one thing in common: an intrinsic and perceived appreciation, irrespective of market fluctuations. And while each investor must do their due diligence and assess what's best for their individual situation, one thing is clear: diversifying and holding a portion of your portfolio in tangible assets can be a wise strategy to navigate uncertain times. In an increasingly digitized world, the way we handle money and financial transactions is transforming swiftly. Many of you might be surprised to learn that the dollar, the world's dominant reserve currency, has had digital roots since 1979, somewhat of a precursor to what we now know as cryptocurrencies. But what does this have to do with financial sanctions? Well, the power and influence of the dollar on the global stage make it a potent tool to enforce policies and pressure nations. When applied, sanctions are not just symbolic statements. They carry broad and tangible economic consequences. Take the case of the sanctions against Russia. An action that appeared to be a mere political pressure mechanism triggered a chain of reactions in the global economy. The most notable? Russia's abrupt decision to halt nickel exports, a crucial metal for several industries. This prompts us to reflect. In an age of interconnection and economic dependence, a nation's actions can have unforeseen and expansive repercussions. And with the digitalization of currencies and the rising influence of cryptocurrencies, the global financial landscape is becoming more unpredictable than ever. It's crucial to stay vigilant, adaptable, and informed about the shifts taking place. Amid the volatility of the economic landscape and the transformations of digital currencies, there is one element that stands the test of time: gold. This precious metal has been the cornerstone of wealth and financial security for millennia, and this tradition shows no signs of changing. Why is this relevant today? Let's look at the strategic decisions of economic powerhouses like Russia and China. In recent years, both have made significant moves to bolster their gold reserves. At first glance, this might give the impression of gearing up for a direct challenge to the American dollar's dominance on the world stage, but the reality is more complex. Indeed, strengthening gold reserves is a way to ensure economic stability and independence in uncertain times. However, this doesn't necessarily mean that the Chinese yuan is ready to dethrone the dollar as the dominant reserve currency. What it reveals is a continual quest for security amidst a volatile global financial environment. And in this, gold shines as a safe haven, a tangible and enduring store of value that transcends epochs and policies. For investors and nations, it's a constant reminder that in the global financial power play, having a solid safety plan is paramount. Given the twists and turns of economic history and the interconnectedness of global markets, it's clear we live in a world where one nation's actions can reverberate across all others. Each crisis leaves us with invaluable lessons, each collapse a warning. In this mosaic of decisions and consequences, the waves of impact are unpredictable and often devastating. But if there's one enduring lesson, it's the importance of diversification, of seeking security in tangible and reliable assets. And in this quest, gold stands out as a bastion of stability. Its age-old presence, its intrinsic value, and its resilience to economic shifts make it a beacon of security in stormy seas. And so, as we navigate the turbulent waters of modern economies, we recognize that now, more than ever, understanding the past, Anticipating future challenges and strengthening our financial foundations is key. Gold, in this context, is not just an asset. It's a history lesson, a reminder that true stability lies in what has stood the test of time. Before we conclude our financial journey today, I have a special request for you. If the insights from this video proved valuable and helped you better understand the intricate world of finance, show your support by giving a thumbs up. This simple gesture helps spread our message further, educating more people on global economic movements. Subscribe to the channel to stay up to date and share this content so others can also prepare. And remember, your input is crucial. Let us know your thoughts, questions, or insights in the comments. Together, we'll always stay one step ahead of financial trends. Until the next video.